Tax planning is an essential strategy for anyone looking to build and protect their wealth. Whether you're a small business owner, a real estate investor, or an individual with significant assets, understanding the tax implications of your financial decisions can make a massive difference in your overall wealth. In this video, we'll explore why tax planning is crucial for wealth builders, how it can help reduce liabilities, and ways you can implement effective tax strategies to maximize your financial growth. Tax planning is the process of analyzing your financial situation to ensure that all elements work together in the most tax-efficient way. It involves strategies aimed at reducing tax liabilities and maximizing the use of tax benefits. This proactive approach not only helps you minimize the amount of taxes you owe but also ensures that you take full advantage of tax deductions, credits, and favorable tax treatments allowed under the law. In essence, tax planning is not about avoiding taxes illegally. It's about being smart with your finances and following legal avenues to optimize your wealth building efforts. 1. Minimizes tax liability. One of the most significant reasons wealth builders must prioritize tax planning is the ability to minimize tax liability. Without a strategy in place, you could end up paying more in taxes than necessary, which can hinder your ability to grow your wealth effectively. For example, investing in tax-advantaged accounts like 401(k), IRAs, or health savings accounts, HSAs, can reduce your taxable income and allow your investments to grow tax-free or tax-deferred. This means more of your money stays invested, compounding over time to build wealth. 2. Protects your wealth. Effective tax planning goes beyond reducing your annual tax bill. It's also about protecting your wealth for the long term. Wealth builders who fail to plan for taxes can face steep tax penalties or unexpected liabilities, especially during significant life events like selling a business, inheriting assets, or retiring. For example, estate taxes can eat into the wealth you've worked hard to build. Through tax planning, you can implement strategies like setting up trusts or gifting to family members, reducing the taxable amount of your estate. 3. Helps achieve financial goals. Wealth builders have specific financial goals, whether it's retirement, purchasing real estate, or funding education for their children. Without tax planning, achieving these goals can be more expensive and take longer. Tax planning ensures that more of your money stays in your pocket, making it easier to meet your financial milestones. By reducing tax liabilities, wealth builders can allocate more funds toward their goals and see them materialize faster. 4. Maximizes investment returns. Investors need to be aware of the tax implications of their investment choices. Different investment vehicles come with various tax treatments. For example, dividends from stocks may be taxed differently from the capital gains you earn when selling an asset. A good tax strategy can help wealth builders choose investments that offer the most favorable tax treatment. Understanding tax brackets and how investment income fits into them can allow you to make smarter decisions, ultimately leading to higher after-tax returns. 5. Ensures compliance with tax laws. As your wealth grows, so does the complexity of your financial situation. With this comes an increasing need to comply with tax laws and regulations. Failure to comply with tax regulations can result in costly penalties, legal issues, and financial setbacks. Tax planning helps wealth builders stay compliant with the ever-changing tax code. By keeping up with new laws and tax reforms, you can adjust your strategies accordingly, ensuring you meet all your obligations without paying more than you owe. 1. Utilizing tax-deferred accounts. One of the most effective ways to build wealth while minimizing taxes is by taking full advantage of tax-deferred accounts. These include retirement accounts like IRAs and 401(k), where your investments grow without being taxed until you withdraw them. For long-term investors, this provides a considerable advantage, allowing more funds to compound over time. 2. Leveraging tax credits and deductions. Tax credits and deductions are two powerful tools that can significantly reduce your tax bill. Deductions lower your taxable income, while credits reduce your actual tax liability. For example, deductions for mortgage interest, charitable donations, or business expenses can save you thousands of dollars each year. Wealth builders should regularly review tax credits and deductions available to them, especially those related to education, energy-efficient home improvements, or business development. 3. Capital gains tax planning. Investors need to be aware of how capital gains are taxed, especially if they frequently buy and sell investments. Long-term capital gains, from assets held over a year, are taxed at lower rates than short-term gains. By holding onto investments longer, wealth builders can minimize their tax liabilities. In addition, utilizing strategies like tax loss harvesting can help offset capital gains with any losses incurred during the year, further reducing tax obligations. 4. Estate and gift tax planning. For wealth builders with significant assets, estate planning is an essential part of the overall tax strategy. Estate taxes can reduce the value of assets passed on to heirs. However, through proper planning, such as setting up trusts or using lifetime gifting, you can reduce the taxable portion of your estate and ensure more of your wealth is preserved for your beneficiaries. 5. Business tax strategies. If you're a business owner, there are additional tax planning strategies to consider. Structuring your business as an LLC, S Corp, or other entity type can have substantial tax implications. Each type of business entity offers different tax benefits, and selecting the right one can lead to significant savings. Additionally, you can deduct various business expenses, from office supplies to vehicle costs, which can further reduce your taxable income. On the other hand, neglecting tax planning can have severe consequences. If you don't take proactive measures to manage your tax obligations, you could face several challenges, including higher taxes. Without a plan, you might find yourself paying more taxes than necessary, which could reduce your available capital for investing or saving. Missed opportunities. Failing to capitalize on deductions, credits, or tax-advantaged accounts could mean missing out on opportunities to grow your wealth faster. Financial penalties. Poor tax management can result in penalties from the IRS or local tax authorities, which could harm your financial well-being. Delay financial goals. Without minimizing your tax liabilities, it may take longer to reach financial milestones like retirement or purchasing property. Getting started with tax planning requires a proactive approach. You don't have to wait until the end of the year or tax season to begin. Here are a few steps to take now. Consult a tax professional. A tax advisor or accountant can provide personalized strategies based on your unique financial situation. Stay informed. Tax laws change frequently. Stay updated on new tax policies that could affect your wealth building strategy. Create a plan, set clear financial goals, and work with your advisor to develop a tax strategy that aligns with them. Review annually. Your financial situation will likely change over time. Review your tax plan regularly to make sure it's still effective. That wraps up our video on the importance of tax planning for wealth builders. If you find this video useful, please don't forget to hit like, comment, and subscribe. Also, click the notification bell so you won't miss any future videos packed with valuable financial tips. Thanks for watching, and happy wealth building!